So our next speaker is David Schwimmer, the CEO of LSEG, the London Stock Exchange Group. David joined LSEG in 2018 after having spent 20 years at Goldman Sachs. I have the pleasure of serving on your advisory board and being involved with a lot of LSEG activities. We are also delighted to have our moderator, Neil Irwin, joining us today. Thank you for doing this, Neil. And as I said in my opening remarks, LSEG is a partner of the Psaros Center. And David, we are most grateful to you for our partnership and hope it continues for a long, long time. Neil, with that, I'm going to hand it over to you.
Thank you. Wonderful to be here. David, thank you. I mainly write not about financial markets, but about macroeconomics and the Federal Reserve. So we're going to focus on financial markets today, I promise. But allow me one point of personal privilege. 2 miles away from here, the Federal Reserve is meeting right now. They're probably going to cut interest rates tomorrow. We don't know exactly how much. As we think about this era of high interest rates we've been in for the last couple of years, what have we learned from it? And are you confident this era of high inflation, high rates is over? What do you make of the global macro situation right now?
So, Neil, thanks for the question. Rena, thank you for having me. Great to be here. And Mike, thank you for your tremendous support for this event. It's funny to me almost that we're talking about an era of high interest rates, because I am still stuck in the mode, if I can call it that way, of thinking, wow, we just got through a period of very I'll say politely, very low interest rates for a very long time. And if anything, that period of time has extended through the careers of most active traders and investors today. And so the notion that for the last few years we've had interest rates in the fives in this market seems to me not to be particularly onerous. And I think that we're still in many ways working through some of the after effects of the lower zero interest rate period. And there's still enormous amounts of liquidity in the markets. I think there is still a disconnect in terms of the valuation in the markets because of 10, 15 plus years of excess liquidity.
In a way that seems dangerous to you?
Potentially, yes. I think the market wobble in early August with what I'll call a modest unwind of the Japanese carry trade combined with a little bit of news in the US, the fact that that led to so much movement and then so much market reaction, I think that tells you there are a lot of crowded trades. There's a lot of leverage still being used in a lot of different areas. So the Fed's mandate is to address inflation and employment. And so it's not the Fed's mandate to squeeze froth out of the markets. But it does raise some interesting questions when monetary policy is partially responsible for creating a lot of the froth in the markets over the last couple decades, how to think about that going forward.
Sounds like we should not be surprised if this is a bumpier path to whatever comes next than some people have been predicting.
I think that's certainly possible. We're not in the prediction business. I think I said at this event last year, we're in the scenario planning business. But we are certainly planning for volatility in a lot of different areas.
So you're based in London, one of the world's oldest stock exchanges. How do you think, we're now 8 years past the Brexit vote, a lot's changed in British politics, in Britain's role in the world. How is London as a financial center evolving? How do you view the role of London and the City of London as in global finance in 2024?
So there's been a lot of soul searching in the UK capital markets really since Brexit and over the last several years. And I think there has been a significant focus in particular as you have seen a slowdown in IPOs on a global basis and a reduction in the number of listed companies on a global basis, in part due to the easy availability of leverage and private capital. The UK has looked at that and sometimes missed that global context and missed that global story and thought really having some sort of questions about its role as an international financial center and global financial leader. There have been some very significant changes put in place really over the past couple of years, and most recently the FCA implemented some changes in terms of market structure, market rules and regulations. The biggest changes really in the last 30 or 40 years. And so a lot of that is about making the London markets, the UK markets, more competitive, simpler, more modern. Some of it relates to, I'll give one example. Historically, in the UK markets, you had to have a shareholder vote to approve a related party transaction. Shareholder vote is kind of a pain. It's a pretty heavy lift. Most other markets have a vote of independent directors to approve a related party transaction. And so that is an example of a change that the UK markets that the FCA has just implemented. But a number of changes like that have been put in place just over the last few months. Some other changes to listing requirements, listing standards over the last couple of years. So I actually think some of this soul searching and some of the existential anxiety has actually been good for the UK markets in terms of forcing the changes. Some of these changes required legislation. I think we all know in the US, in the UK, and other places, it's hard to get legislation through on some issues like this. So to have that kind of motivation to really drive market structure changes when legislators could be focused on lots of other things, I think that's been a good thing.
So you may not be politically part of Europe anymore, but you are still geographically part of Europe. Mario Draghi, the former ECB president, the former Italian prime minister, had a fascinating report that came out last week, basically addressing European competitiveness and pointing out, there's some amazing data points in there. There's been no European company worth more than 100 billion started in the last 50 years in terms of entrepreneurial non-activity. It looks like U.S. companies are leading on AI and a lot of the more innovative areas. What role can capital markets and LSEG in particular play in making the European economy as a whole more vibrant?
So part of what Draghi called for was an incremental 800 billion euros of investment to drive a lot of this change and try to drive improvement in the competitiveness of Europe relative, I think, particularly to the U.S. and to China. I think it is. I think it's an interesting and important challenge for the EU, and there have been 20 plus years of discussions around, for what's relevant to us, improvement of market structure and greater efficiency, for example, in clearing and settlement in Europe, and the creation of a capital markets union. This is something that we've been pushing for a long time. I think the notion of having multiple regulators in all the different EU countries, that's one example of inefficiency. We think the concentration of regulation, of capital markets regulation in ESMA as a European regulator would be a greater efficiency and one interesting step in the direction towards creating capital markets union. There are other things like consistency around insolvency, consistency around tax, allowing bank consolidation, various other things. But just to give an example on this issue, we have two clearinghouses. Mm-hmm. We have a clearinghouse in London, LCH Limited, which operates all over the world, systemically important, clears interest rate swaps, including US dollar interest rate swaps here. Because it's based in London, it's regulated by the pan-EU regulator, ESMA. We have a clearinghouse in Paris, LCH SA, which clears, also systemically important, a very significant clearinghouse, clears other asset classes. Because it's based in Paris, its primary regulator, or regulators, are the French. So the Banque de France, the ACPR, and the IMF, which is somewhat unusual.
Different.
Yes, given two clearinghouses, both in Europe. One's outside of the EU and regulated by ESMA. The other one is inside the EU and regulated by the national regulator. And so that's just an example of some of the issues that I think Draghi is calling out in his report in terms of the opportunity for greater efficiency and consolidation among a lot of these different structures to make it easier to operate within the EU.
One more macro question before we talk about more LSEG specific things. Let's talk about geopolitics and how it interplays with markets. Last couple of years, we've seen a war in Europe, war in the Middle East, Chinese economy having serious problems, election coming up in the US with a lot at stake. There have been 2 assassination attempts on one of the candidates in the last 2 months. Meanwhile, equity markets are all-time highs. Things aside from the occasional bump on the road, as you alluded to earlier, have looked frothy in some ways. How do you read the global risks out there? And is geopolitics writ broadly a risk that investors need to be more cognizant of?
I think that geopolitics in a lot of markets actually do get a lot of attention. And I think this comes back to a little bit what I was saying earlier in terms of a lot of the liquidity in the markets and potentially some of the froth in the markets. It is the performance of markets, broadly speaking, has not been that spectacular when you strip out, for example, the Magnificent Seven in the US markets. So I think there is some pricing of the geopolitical risks. And you see that in some aspects of the equity markets. You certainly see that in some other markets as well, whether that's commodities or some of the fixed income markets or certainly currencies. So we could have a separate conversation as to whether the markets are getting it right. And I think it's hard to answer that. And we will only know in retrospect. But I think geopolitics certainly are playing a significant role in terms of driving volumes. And so we could have a discussion around what the right valuations are, what the right levels are. But I think it's very interesting to see when you have an event, a surprise, something unexpected in a certain market, the amount of volume that flows very quickly to reprice in line with that surprise sometimes is overwhelming for different elements of the markets. And so that's something that we and I think others who are really responsible for the plumbing in the markets need to keep a very close eye on, whether that's in the US, whether that's in Europe, elsewhere. So.
Let's turn to AI. You run one of the world's oldest stock exchanges, hundreds of years old. You're also a tech company. You're partnered with Microsoft. Just give us an overview, a tour of what you're trying to do with AI as you both internally focused in running the company, externally focused in making these markets work better. What does the future look like?
So we are using AI functionality in many different areas, but I'll put it largely in 2 buckets. Internally, we are using it to drive significant operational efficiency. And so an example of that, we have 26,000 people around the world. Of that, about 2,000 are involved in responding to customer queries. And given the breadth of our offering, the massive amounts of complex data, analytics, workflow models that we provide to our customers, sometimes we get a lot of queries, and sometimes those queries are very complex. So one function that we put in place, enabled by AI, is basically, we call it QAS, a question and answer service, which includes all of the internal documentation that we have on all of the different elements of data that we provide. So we can arm our 2,000 customer service people with an LLM to help them respond to questions. And so far, and I say so far because it's still improving, so far that has made those 2,000 people, when they're using the QAS model to respond to customer queries, and made them 50% more productive. So that's very significant. And the model gets better and better, and we hope, we'll see what the time frame is, maybe end of next year sometime. We hope to just expose that model directly to our customers. So you have a customer about our data or our analytics, you're interacting directly with our model and getting those answers directly. If that doesn't work, of course, we will make a human customer service rep available to help you. So that's in the category of operational efficiency. We're also embedding it, and you touched on our partnership with Microsoft. So December 22, Microsoft took about a 4% stake in us, and Microsoft's head of cloud and AI, Scott Guthrie, is on our board, which is just fantastic insight to have on our board. We're building product together with Microsoft in a number of different areas, but one example of what we're doing it's a Microsoft product. It's called Meeting Prep. It will be a button on the Teams screen, and it will enable you, if you have a meeting with someone, to put that name into this little box, and within less time than it is taking me to explain this to you, you'll have a multi-page Gen AI written briefing memo on that person. And the cool part is that that information on that person is your proprietary information coming from your emails, your files, your CRM system, combined with our public data. So pricing data, news, information about the company, the board, salary, et cetera. And that we are piloting this right now with a number of customers. There are a lot of people who spend a lot of time getting ready for meetings with people. And so this is something that...
Here, I did all this prep for today, and I could have just skipped it and had the bot...
Exactly. We could have gotten you a nice memo within about 10 seconds. So that's coming. And that's an example of how we're embedding what's a very powerful AI technology with our data and in the Microsoft workflow that hundreds of millions of people around the world use. I think pretty exciting.
Yeah. So it seems like as financial markets get more complex, think about the rise of algorithmic trading over the last few decades, these systems can get too complex for any one human brain to really understand everything that's going on. There have been flash crashes. There have been things that just get out of control over the years. Does AI supercharge that? Does that create new risks on the financial stability side that we should be worried about?
I think there are aspects of AI that you absolutely have to take a close look at from a financial stability perspective. And I think to the extent that there is more trading driven by algorithms, which you could put in the category of AI if you wanted to, depending on what kind of algorithms you're using, that does create an incremental risk. And so to have speed bumps, to have kill switches, various other things like that, I think are important. I think there's another aspect of AI that is really important, which is to be able to identify where the information is coming from, to make it auditable. To make sure that the quality of the data that is going into informing a large language model is very high. In other words, I think we're all familiar now with the notion of hallucinations and the fact that you can have a model that's maybe 90 or 95% accurate. In our sector, 95% accurate is not good enough. It's not even remotely close to being good enough. So how do we make sure that the data that is going in to inform the model is accurate, verifiable, auditable, and that you can get to a much, much higher percentage of accuracy in terms of the tools that you're using that are informed by AI. I think that's a really important aspect of this as well.
So let's do a couple more topics specifically on your business. Tell us about the partnership with FMX, your efforts to get into U.S. Treasury futures. Why do you think that's the right strategy? How's it going?
So this is really entirely consistent with how we approach clearing. And what I mean by that is LCH, we have an open access clearing model. So if a company meets our risk management and disclosure standards and regulatory standards, then we are open to clearing for them. In the US, you've had the CME in the Treasury future space having, I'll say, a very, very, very high market share. In FMX, a competing venture. A lot of people have tried to go after that volume. So FMX is an industry consortium led by BGC. And they asked us to clear for them. And so we are clearing for them. And we think it's good for the markets. We think competition is a healthy thing. It's consistent with our open access philosophy. There has now been a lot of discussion about the competitive dynamic between CME and FMX. And LSEG and LCH are being pulled into that because of the benefits of the cross-margining that we provide. And I understand that the CME has talked about the compelling aspects of the cross-margining for cash and futures products. I I think the point that has been made about our clearing pool is that it is much, much larger than the CME's collateral pool, and that the cross-margining capabilities will therefore be much, much larger. Does that mean that FMX will take lots of market share away from CME? I don't know. I think we all know liquidity tends to stay where liquidity is. But again, I'll go back to where I started with this, which is we think that competition is good for the market, and we are an open access provider. So we look forward to seeing how that plays out.
One more question before we head to your questions. You're looking to expand in unclear derivatives. What's the strategy there? What are the risks, opportunities? What are you up to there?
So this is another really interesting opportunity for us. Our clearinghouse, LCH, has a very strong position, very high market share in terms of serving the industry globally in the clearing of interest rate swaps, foreign exchange derivatives, repos. There is an uncleared space, uncleared derivatives, that in terms of notional amounts, in terms of activity, is about the same size as the cleared space. Clearing has brought enormous efficiencies, capital efficiencies, cost efficiencies to the industry. And some of that was in response to regulation at the Pittsburgh G20 and the mandate to clear interest rate swaps. That has largely been successful in terms of reducing risk and improving efficiency and optimizing capital. The uncleared space is in a very different position, where you have thousands of bilateral contracts that don't get the benefits of what I'll call the ancillary aspects of clearing. In clearing, you have a clearinghouse that's the intermediary, so coming in as the buyer to every seller and the seller to every buyer. But the clearinghouse also provides many other things, like standardization of documentation and agreement on collateral and margin, authoritative data, various other things like that that make the cleared space, forgive me for saying so, but very clear. And you don't have a lot of people at banks in middle and back office working on reconciliation in the cleared space. Uncleared space, very different, huge burden for the industry in terms of doing reconciliations, in terms of working through disputes, and just in terms of trying to agree on pricing and collateral and terms. We are looking to bring all of that standardization, all of those ancillary benefits into the uncleared space and basically become the clearinghouse for the uncleared market. And so that's something that we're actively building. We are not doing this on spec. We're doing it in partnership with the industry, working in partnership with many of the large banks. And I think it will provide significant benefits in years to come in terms of efficiency and in terms of capital optimization, in particular when you look at some of the capital effects of rules like SACR and other things. So it's something that we're very excited about, and it's something that I think will really benefit the industry.
One quick thing before we go. You're an American based at a very historic British institution. Have you picked a Premier League team, or are you studiously neutral? Are you Switzerland in British soccer, or do you?
I think the important fact here is that my son makes this choice, and he is a Chelsea fan.
Gotcha.
So apologies for anyone who disagrees with that, but it's not up to me.
Start on this side.
Hello. Do you hear me?
Yes.
Okay. I'm a senior in the SFS coming from Turkey studying international economics. My question will be localized with respect to Britain. What are your current thoughts about the current Prime Minister's policies and Chancellor of the Exchequer Rachel Reeves' policies with regards to banks and financial markets?
So probably the best thing I can say about, or the most effective thing I can say about that in answering your question is that we have seen real consistency across the change in government in terms of the focus on the importance of capital markets in the UK. And this was a priority under the Tory government, and it has been a priority under the Labour government. And I touched earlier on some of the reforms that have been put in place. Those started under the Conservative government and then were implemented under the Labour government. And there are many different examples of that. So it's actually very interesting to see in a lot of markets you have a sort of a pro-business and an anti-business dynamic, and might see that in a change of government as we've had. I think what we're seeing in the UK currently is that there's a real recognition of the importance of capital markets and a strong financial sector to driving growth for the economy.
Thank you very much. And, okay, there's one more question. I had a second question, but if
why don't we go to him, and
course,
if there's a shortage, we will certainly come back to you.
No problem. Thanks, David, for being here. Last year, we learned about the intermittent trading venue project. Can you talk more developments on it, and what's the current status of it?
I am glad you brought that up because Mike and I had a discussion about that here last year, and there continues to be a lot of excitement about it. So for everyone's benefit, what we were referring to last year, the intermittent trading venue, the government has rebranded it as Pisces, which is a wonderful acronym, which I will spare you the details of. This is intended to be a crossover market for private companies to be getting access to public market infrastructure. So if you are a private company, you don't want to go public, but you have either investors or employees who want liquidity, you can be available for trading on the London Stock Exchange. You put out a disclosure document in advance, and then after that day of trading, or that 2-hour time period, whatever you want it to be, you go back to being a private company. And so we have referred to it as an intermittent trading venue. And there is a lot of interest in this. I think this group may be well aware there's a significant amount of private equity assets that have not gone to the public markets over the last couple of years for a variety of reasons. And we think that this market structure will be well suited to handle that. It is coming with the full endorsement of the FCA in the UK. But that is also taking some time. And so we were hoping that it would be ready this year. It's looking like it will now be coming in the first half of 2025. But thank you for asking about that. It's something we're excited about. I think it's something that will be a welcome innovation in the market.
Thank you.
I guess we'll do this last question.
Yes, hi. So first, thank you for taking the time to be with us today. My question is, with many UK companies, particularly startups, seeking funding in the US and sometimes being acquired by US corporations and investors, what specific steps can the UK government and financial institutions take to make the domestic market more attractive and competitive for these companies?
So this is another topic that's gotten a huge amount of focus and discussion in the UK. And in addition to a number of the reforms that I was talking about earlier, there's one other enormous opportunity for the UK to drive a shift in its financial markets. And this relates to a reform of the pension fund sector in the UK. So the UK pension sector is, either, depending on how you count, either the second or third largest in the world, after the US and probably Japan. And yet, it is highly fragmented, and the average pension fund size in the UK is probably around £300 million. You compare that to other markets like Canada, where it's a smaller market, but you have much greater concentration, and you have a small number of very large, world-class, professionally managed pension funds that allocate their capital all over the world and are very well known for doing so. The UK is looking at creating a model like that. And what happens in the current model is that when you have a number of very small funds, that if you have a £300 million pension fund, you are likely only investing in index products and gilts, the UK government bonds. You're not investing in venture capital. You're not investing in private assets. You're not investing in infrastructure. Many, many different investment opportunities that would be very good and very healthy for the UK market and the UK economy. So that's not something that will be addressed overnight. but it is something that the UK government is looking at. There's a consultation going on right now by the minister who is responsible for overseeing pensions. This is something we're actively involved in, and a number of others in the industry. And I think you could get to a place in a fairly short amount of time where you have a much more significant amount of capital flowing into a number of these other investment opportunities or asset classes that could have a real impact.
That's all the time we have. David Schwimmer, London Stock Exchange Group, thank you very much.